We're now going to start the second section of the Series 99. And this section is about basic knowledge associated with broker-dealer operations. This makes up 48 questions of the 100 questions on the Series 99. In this first section, we will discuss what is required when a customer opens a new account. All new clients must fill out a new account form that is kept on file at the broker-dealer. It is the representative's obligation to collect the following information about the client: the customer's name, address, date of birth, social security number or tax ID number, the registered rep's name that will handle the account, and a principal's signature. The client's occupation and employer, and whether the client is an officer or director at a publicly traded company, whether the client is employed at a bank or broker-dealer, the client's citizenship, whether they're opening a cash or margin account, and any third-party authorization. This tells whether there is anyone else who has been given permission to trade on the account. The representative also needs to collect suitability information, and that's the information in yellow in this slide. So they have to collect the customer's age, their investment experience, their liquidity needs, their risk tolerance, their net worth, their investment objectives, and any estimated annual income, and their tax status. Note what's not on the form. The customer's educational background is not required information, and the customer is not required to sign the new account form. You will see for margin accounts that the client does need to sign, but for a plain vanilla account, no client signature is necessary. All new account forms must be kept for up to 6 years from the closing of the account, or from any replacement information that has been given. And the firm must send a copy of the new account form to the customer within 30 days of opening the account. The U.S. Patriot Act requires all member firms, and by member firms I mean firms that are members of FINRA, they all have to have a customer identification program in place. And this program requires that the client's name, date of birth, social security number, or tax ID is used to verify the identity of the customer. And this verification is done when the customer comes in to open the account. And it is usually done with a current driver's license, passport, or some other government-issued identification. But a social security card is not enough. The member firm is, at that time, the member firm is also required to check if the person is on a known or suspected terrorist list from the Office of Foreign Assets Control, often called OFAC. And this list is called a Specially Designated Nationalist List, or an SDN list. Now, these rules were put into place to detect and deter money laundering and the funding of terrorist organizations. The records relating to the customer identification program and the identification process need to be kept for at least 5 years. So there's an important rule that you will need to know regarding opening an account, and that is called the Know Your Customer rule. And this requires broker-dealers to use reasonable diligence to collect and maintain essential information on their clients when they open accounts. So they have to include information necessary to effectively service a customer's account, carry out special handling instructions for the account, understand who has trading authority on the account, and to comply with securities laws, regulations, and rules. So according to the rule, when information on the new account form is missing, a supervisor should be informed, and there should be documentation about inquiries into the missing information and reasons why it wasn't provided. The supervisor should make sure that the missing information was not an essential fact, and the rule requires that representatives make regular contact with their customers, checking whether investment objectives or essential facts have changed. Now, this may require checking in with their customers more often than the standard rule, which is every 3 years. Broker-dealers are required to make suitable recommendations for their clients. In order to do this, the broker-dealer should exert their best efforts to collect suitability information. The suitability information includes the information that was in yellow on that first slide. And this information is then used to make sure that a broker's recommendations are suitable for a client. So if the client refuses to provide the information, the broker still can open the account, but they can't make recommendations for the client. But they can still accept unsolicited orders, and those would be orders that the client comes to them with. Like the client comes and says, I would like to buy 100 shares of Microsoft. The broker-dealer would be allowed to do that if they don't have suitability information on the client. FINRA has 3 standards of suitability that broker-dealers must stick to. The first is called reasonable basis suitability. And this means that the broker is required to determine whether the investment would be suitable for any investor. And this usually requires doing some due diligence on the company. Is the company sound? Is the investment sound? The second standard is called customer suitability, or customer-specific suitability. And to fulfill this requirement, the broker must determine whether the investment is appropriate for the customer based on the customer's specific suitability information. Is this right for this specific customer? The third standard is called quantitative suitability. And it requires that broker-dealers make sure that the number of transactions in an account is not excessive given a client's investment goals. Broker-dealers are not held to such strict suitability rules for institutional clients, however. So an institutional client would be a bank, savings and loan association, an insurance company, a registered investment company, a registered investment advisor, or any other person, including individuals, with total assets of at least $50 million. If a broker-dealer believes that the institutional client is capable of independently evaluating risk and that they regularly make independent investment decisions, the broker-dealer's suitability requirements are fulfilled. When a customer opens an account, the broker must collect registration and delivery instructions from the client. So on the exam, you might see these instructions called standing settlement instructions. And there are 4 possibilities. The first is called transfer and ship. And that means that the securities are transferred into the name of the customer and shipped directly to them. So this obviously means that the securities have to be held in certificate form. The second kind is transfer and hold in safekeeping. And again, in this case, they're transferred into the customer's name. It's a certificate form, and they're held at the broker-dealer. The third type, and this is the most common way that securities will be, or the most common type of instruction. The securities will be transferred to the broker-dealer's name and held by the broker-dealer. That's called holding the securities in street name. And in that case, the customer will be the beneficial owner, but the broker-dealer will be the owner of record. So the customer will get all the benefits of ownership, like being able to vote the shares, they'll receive the dividends, etc. But the official owner or the legal owner will be the broker-dealer. The final instruction possibility is delivery versus payment, or DVP. And in this case, the customer instructs the rep to deliver the securities to a bank, which pays for them on delivery. And in that case, the broker-dealer will need to receive information about the bank. Where are those securities going to be shipped to? Broker-dealers are required to send their customers account statements at least quarterly if there's been any activity in the account since the last statement was given. So in this case, activity includes any buying or selling of securities, but it also includes a deposit of dividends. So if one of their stocks paid a dividend and it automatically went into the account, this would be considered account activity. It also includes any transfer of securities from one account into another. So if a customer has more than one account, if they transfer securities from one account to another, that would be considered activity as well. So what needs to be in those account statements? Well, according to FINRA, an account statement must contain a description of any securities positions, so any holding that the customer has of a security, or including if they have short sold a security, any money balances, meaning do they have any cash in their account, any account activity, and it has to include a statement that advises the customer to report to the broker-dealer any inaccuracies or discrepancies. That account statement also has to advise the customer that any oral communications that were made with the broker should be reconfirmed or followed up in writing to protect the customer's rights. A shareholder of a company may vote or has the right to vote on important issues either in person at a shareholders meeting or by proxy. And when I say proxy, that is a written statement by the shareholder authorizing someone else to vote on their behalf. So how it usually works is that a proxy voting card is sent to you with an annual report, and you fill out that voting card if you're not going to be at the shareholder meeting, and that will tell the company how to vote your shares. Shareholders who hold shares through direct registration, and that means they're registered through at the company, are sent the proxy voting card and annual report directly to them from a transfer agent. Now that, as we'll see, that's going to be a little bit different than when the shares are held in street name. So when securities are held in street name, the broker-dealer is required to promptly send the annual reports, the proxy materials, and any other information from the issuer to the beneficial owners of the securities. So how this works is the shareholder receives a voting instruction form from the broker-dealer, which they use to tell the broker how to vote their shares. If within 10 days of the shareholders meeting the shareholder has not sent back the form, the broker-dealer is allowed to vote the shares for them. But the broker-dealer can only vote on routine votes, not really important votes.